My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Despite elevated uncertainty, the economy is in a solid position. The unemployment rate remains low, and the labor market is at or near maximum employment. Inflation has been running somewhat above our 2% longer-run objective. In support of our goals, today the Federal Open Market Committee decided to leave our policy interest rate unchanged. We believe that the current stance of monetary policy leaves us well positioned to respond in a timely way to potential economic developments. Recent indicators suggest that growth of economic activity has moderated. GDP rose at a 1.2% pace in the first half of this year, down from 2.5% last year.
So today, the U.S. Federal Reserve made a major announcement. Let's talk about what just happened and why it matters more than you might think. Today, the U.S. Federal Reserve announced that it's keeping interest rates steady at 4.25 to 4.0% for the fifth time in a row. Now, you might be thinking, okay, so what? Well, that single decision affects your rent, your loans, your savings, even your job. And if you've been feeling like your money just doesn't stretch the way it used to, this is why. So in this video, we're breaking down what this decision actually means for everyday people, why the Fed is holding the line, and what you should do next, whether you're a student, a business owner, or just trying to stay ahead of inflation. Segment 1. What is the Fed actually doing? Let's start at the top. The Federal Reserve, or the Fed, is basically the United States central bank. One of its main jobs? Control inflation, which means keeping prices stable so your grocery bills, gas prices, and rent don't spiral out of control. One of the main tools they use is the federal funds rate, an interest rate that banks use to borrow money from each other overnight. When the Fed raises this rate, it makes borrowing more expensive. That slows down spending, cools off the economy, and helps bring down inflation. When it lowers the rate, borrowing becomes cheaper, which usually encourages growth. But it can also risk overheating the economy if done too much. Right now, they're holding it steady at a range between 4.25% and 4.50%, the highest it's been in over 2 decades. Why? Because the Fed believes inflation is starting to cool, but not enough to declare victory yet. Segment 2. Why the Fed didn't cut or hike. This part is crucial. A lot of people expected the Fed might start cutting rates by now, especially with talk of a soft landing, a scenario where inflation drops without causing a recession. But the Fed is choosing patience. Jerome Powell, the Fed chair, has made it clear they're watching inflation numbers very closely, especially in key sectors like housing, services, and wages. While overall inflation has come down from its peak of 9% in mid-2022 to around 3.2% today, certain prices like rent and food are still rising faster than most wallets can handle. So by holding rates steady, the Fed is saying we're not tightening more, but we're also not ready to loosen up. What it means for you. Now, let's get to the part that really matters. How does this affect your life? If you rent or own a home, mortgage rates remain high, hovering around 7% for a 30-year fixed loan. If you're looking to buy a house, monthly payments are still expensive, so many buyers are on pause. For renters, landlords often raise prices to keep up with costs. Don't expect rent to fall just yet. If you carry credit card debt, this is big. Credit card interest rates are directly impacted by Fed decisions. Right now, average APRs are around 20 to 24%. That means if you're only making minimum payments, you're bleeding money in interest. If you have student loans, federal student loan interest isn't tied directly to the Fed rate, but private student loans often are. If you refinanced or took out private loans, your monthly payments could be higher than they were a few years ago. Auto loans. Car prices have cooled a bit, but interest on car loans remains elevated. Monthly car payments are now higher on average than ever before, around $750 a month for new vehicles. If you're saving money, this is the one upside. High-yield savings accounts and certificates of deposit Ds now offer 4 to 5% interest. So if you've got emergency savings, now's the time to park it where it earns more. Segment 4. Will rates ever drop? That's the million-dollar question. Markets are predicting that the Fed might start cutting rates by the end of 2025 if inflation stays on the decline and unemployment remains low. But Powell has stressed that the Fed is data-driven, not market-driven. If inflation flares back up, especially with global supply issues or energy prices rising, they might even raise rates again. So don't bank on rate cuts anytime soon. Prepare for high borrowing costs to stick around a while longer. So what should we do now? Here's what everyday people can do right now to adapt. 1. Pay down high-interest debt, especially credit cards. 2. Refinance smartly, but only if it makes long-term sense. 3. Save in high-yield accounts. Make your money work harder. 4. Delay big purchases if they rely on credit, unless the deal is worth it. 5. Track inflation. Knowing where prices are rising helps you budget smarter. So the Fed didn't raise rates, but that doesn't mean everything is back to normal. In fact, this pause is a signal, a warning even, that while inflation is cooling, the fight isn't over. And if you're not planning your finances with these interest rates in mind, you could feel the pinch sooner than you think. Like, subscribe, and let me know in the comments. How are you coping with high rates right now? Cutting back, saving more, or just hoping the Fed cuts soon? Thanks for watching. Stay sharp and stay financially prepared.
One more question on the lack of unanimity in today's decision, the two dissents. Was there talk during the meeting? I know you're not going to talk about exactly what individuals said, but in general, was there talk during the meeting of cutting rates, and what was the case against that at the meeting?
Sure. So, we have an economic go-around where people talk about the economy, and then the next, and that's yesterday, and then today we have a monetary policy go-around. All the way around the table, everyone gives their views. So the discussion around policy was, the majority view was still what it has been, which is that inflation's running above target, maximum employment is right at target. That means policy should be a little bit restrictive, somewhat restrictive, because we want inflation to move all the way back to its target. So that's where people have been and still are. Two of our members felt that the time had come to cut, and that they, for the reasons that they're going to express. I won't tell you the reasons. They'll issue some kind of a thing in the next day or so. So, but that's the story, and I would say, well argued, very thoughtfully argued all around the table, good arguments, and it's a situation where, an unusual situation. The economy is in good shape, but it's an unusual situation where you have risks to both your employment mandate and your inflation mandate. That's the nature of a supply shock.
We have a lot of money coming in, and we have no inflation, and we're very strong, and we should be lowering the rates.